Well, good morning and welcome to Business Morning. I'm Ladi Williams. Today, we're tracking the numbers, shaping Nigeria's economic outlook. On the front burner, rising debt pressure on the states, also looking ahead at fresh momentum in Nigeria's gas sector, from ambitious production targets, to multi-billion-dollar pipeline investment. So much to unpack today, but let's get a check on the oil market. Now, we're seeing oil prices ticking higher this morning as geopolitical tensions return to the spotlight. Investors are closely watching, escalating friction between the United States and Iran, amid fears that any disruption to Tehran or key shipping routes could tighten global supply. And we see Brent crude, that climbed to nearly $70 a barrel, while U.S. West Texas Intermediate also posted gains, extending Wednesday's rally despite, rising American crude inventories. Markets are now weighing whether diplomacy holds or whether fresh risk could send energy prices even higher. I was tracking the price yesterday. It did touch $70 per barrel for a bit. Then we see that pull back. But Brent has not been able to break that level conveniently so far. We'll see what happens for the trade tomorrow. And Nigeria's refining landscape is hitting a major milestone. The Dangote Petroleum Refinery has reached its full nameplate capacity of 650,000 barrels per day, following the restoration and optimization of its crude distillation and petrol production units, a scale the company calls a global first for a single train facility. The plant has now begun a 72-hour performance test with technology partner UOP to confirm stability, efficiency, and international standards. The move signals stronger domestic fuel supply and a potential shift in Nigeria's import dependence. And now to oil production. Nigeria has failed to meet its OPEC-assigned crude oil production quota for the sixth consecutive month. And this is according to the Organization of Petroleum Exporting Countries' monthly oil market report. The report shows that Nigeria's average daily crude oil output slipped to around 1.47 million barrels per day in January 2026, a slight decline from the figures recorded in December 2025. This remains below the nation's OPEC quota of about 1.5 million barrels per day. The broader OPEC report also adds that overall oil production among the group's members that declined in January 2026, with reduced supply from Nigeria and other producers contributing to lower aggregate output. So I guess it's not just Nigeria. Looking at regional comparison, Libya, that was second in Africa, about 1.37 million barrels per day. The OPEC quota, that's 1.5 million barrels. That's 50,000 short there, 50,000 barrels per day short. Production trend up from the 1.42% in December 2025, 2.11% drop from the previous month. So that's the color right there for oil production, and definitely we know this impacts government revenue. All right, to other matters now. Liquidity. We see the Central Bank of Nigeria, they're stepping up its fight against inflation, dramatically tightening liquidity across the financial system. Almost sales surged 16-fold year-on-year to 8.5 trillion naira in January, as the Apex Bank aggressively, mops up excess cash parked by commercial banks. In total, more than 33 trillion naira was drained last year. Moves have slowed, money supply growth to a 5-year low so far. We see the impact also in inflation. We're supposed to feel that with the inflation numbers. To the markets now. Investors are smiling on the Nigerian exchange this week, pocketing more than 4 trillion naira in gains over just 3 trading sessions. Market capitalization climbed to 114 trillion naira as the all-share index jumped nearly 4% there, 178,184 points, 0.78% advance, lower than the over 1% gains we've been used to this week. Is that signaling something? All right, volume, 939 million that was traded, valued at 34 billion naira, deals 61,279. Other parts of the market there, we see Nestle there, that topped the gainers chart, big 10% advance. Mayor Paints, big 10% advance to closing at 20 naira 90 kobo there. And FTG Insure, that's 10%, 33 kobo to close. So the laggards now, Honeywell Flour 9.70% down. Nimeth, that's the pharmaceuticals, that dipped 9.15% yesterday, closing at 12 naira 90. We're seeing profit taking right there for most of the pharmaceutical giants listed on the NGX after a run in 2025 into 2026. Top trades, Tantalizers, 85 million traded. Access Core, 61 million, had a pullback yesterday. We see Chams, 38 million traded. Definitely markets about to open at this point. We'll see what the trades hold later on. All right, so some company news now. Flutterwave, one of Africa's leading fintech companies, says it's bridging a major gap for Nigerian businesses by enabling companies of all sizes to make and receive payments globally. Founder and CEO Olugbenga Agbola outlined the company's global expansion roadmap during a gala in Lagos, celebrating Flutterwave's 10th anniversary. Mr. Agbola highlighted the recent acquisition of Mono, Africa's leading open banking platform, as a key step in strengthening the company's infrastructure. Take a listen.
Notable dignitaries are joining industry leaders as Flutterwave is marking its 10th anniversary with a gala organized in partnership with the Delboro. Beyond the celebration, the event signals a new phase for the fintech company as it unveils its global scaling roadmap, positioning itself as a foundational digital payments infrastructure provider across key sectors of Nigeria's economy and beyond.
The last 2.5 years, we have been able to plant our seeds across global territories like the US, like the UK, like the EU, with banking infrastructure and licenses through partnership with Nuvia. And that is key because we envisage a world whereby payment can now be actually borderless without a need to use any corresponding banking platform between us.
Nigeria's former president Obasanjo highlights fintech's transformative role in driving job creation, industrialization, economic diversification, and global competitiveness.
The resources for development must be made to correspond with the opportunities so that the men and women, the opportunities and the resources put together will make us get to where we should be.
The evening features tributes recognizing Flutterwave's decade-long impact on Nigeria's digital economy and its contributions to expanding financial access across Africa.
We can actually use his story and other story to rekindle and to reshape the story of Nigeria by giving opportunity to everyone that we need to.
The company also reaffirms its commitments to shaping the future of commerce, citing its recent acquisition of Mono Open Banking Technology Platform to strengthen secure financial data access and direct bank-to-bank payments. Looking to the future, the company says the coming decade will center on expanding financial inclusion and advancing its mission to connect Africa to the global economy through seamless and secure payment solutions.
All right, big congrats there to Flutterwave. All right, to our first conversation now. State governments across Nigeria they're under growing, financial pressure. Debt service payments are rising, leaving less money for development. But here's the dilemma now. Many of the roads, bridges, power projects, and industrial parks we rely on today were funded with borrowed money. So is borrowing still the smart path to growth, or are states digging themselves into a debt trap? This morning, we examined the balance between debt and development and whether Nigeria's states are investing wisely or over-leveraging their future. Joining us for this conversation now, we have Mr. Paul Alaje, Chief Economist, SPM Professionals, to help us unpack this. Great to have you on the show, sir. Good morning.
Yeah, good morning, and thank you.
All right, so looking at the data for the top 5 states there, we see Lagos leads with 2025 foreign debt service at 92.80 billion naira, up about 28.33% compared to the previous year. Rivers comes in second, 48.58 billion. That's for debt servicing, foreign debt servicing. It's up 110.02%. Kaduna comes in third, 47.93 billion naira for debt servicing, foreign debt servicing, 5.13% compared to 2024. Ogun State comes in at fourth with 25.20 billion. That's up 110.22% according to the data. Cross River, 21.01 billion naira, 22.86% up. Then when you look at it from a regional, from the regions in Nigeria, now we see Southwest, 162.77 billion cumulative there, holds a 35% share for debt servicing costs in Nigeria. South-South, 100.37, that's cumulative, 22.04% share for that region. So definitely we're seeing the debt levels there servicing exactly. Foreign debt service in 2025 as a whole for the country, most of the states there, 455.38 billion. That's a big number. Mr. Paul Alaje, I don't know if you can hear me now.
Yes, I can hear you. Thank you so very much for having me.
Fantastic. Great to have you, sir. So definitely we've seen the numbers there according to the data. So when does borrowing, become productive debts, versus dangerous debts? Looking at the data we've seen so far, we see some states there, debt servicing rising over 100%.
Yes, debt service has increased sporadically, nearly over 100%. That has major implication for the subnational economies. It will also serve as a cost, and the cost here, as economists, is the true cost. It's not cost of just servicing. The true cost, which is worrisome, is what would have used revenues to do, which includes provision of schools, provision of basic hospital, primary and secondary health provision, and most importantly, provision of infrastructure. At the end of the day, what matters to majority of our people is quality of life and ease with which they can live their life decently. Majority of the people in Nigeria live in one subnational or the other. If cost of borrowing has eroded so much or has crowded out the impact of investment in the state, the truth will be that for most of those states, investment will be hampered, investment will be thwarted. And when this happens, most revenues that should go into such investment will go either into domestic servicing or foreign servicing. In the case of foreign service alone, we have seen sporadic jump of nearly 30%, and domestic from the number you have shown, which shows the combination of all, it shows that we need to be very careful. When you look at what we did last year and what we do this year, and what we did 2024 and what we did last year, I understand with Mr. Wale Edun when he said that we need to have a zero mandate to borrowing for 2026. Here is it. If we don't do something about consistent borrowing, not just at federal level now, even at the subnational, we're going to put our exchange rate again under severe pressure. We have seen relative stability and some marginal improvement from 1,500 now to 1,340, 350 exchange rate. That should be commended. However, when debt grows sporadically, especially foreign debt, in a state where we have significant inflation, it will certainly have impact on the economy. So what should we be doing instead? Quite a number of things. But it's important for us to see that the money borrowed, on what are we spending? And to be fair, some governors have said, we made this money, we're not the one that borrowed. Now we practice democracy. So when you come into office, you are technically inheriting all the good, including secretariats that your predecessor has built, hiring humongous number of civil servants, whether they are all productive or not, you have inherited them. So when you say that I am Mr. Fix-It, I am here to fix the problem, when you jump into the river or into the sea or a pool in your house, please don't complain of water. We are here to solve the problem. Therefore, the problem must be solved. So the time to complain is not here, is not there at all. This is where we need to put up a thinking cap at the subnational and at the federal level into looking at how can we solve our fiscal challenge, because this is real fiscal challenge that steers the state in its way. Remember that around 2021, 2022, 2023, 2021, 2022, the federal government came to the aid of subnational, giving them facilities, in some cases, giving the state palliatives. Was that able to bail them out of economic quagmire? The answer clearly is no. Why? Because reports had it that 25 of the 36 states plus FCT had major economic crisis. We have seen with the report that was recently published, with the exception of Lagos State, and perhaps you might want to also consider River State, but most of other states, you will see that they have significant or some level of impact with increase in their debt service. What should we therefore do is perhaps to boost IGR, to also think of having public-private partnership at the subnational level to help the states improve their investment or what they have spent money on. But this is what we should look at. And I am recommending this for state assemblies and indeed the National Assembly. For the states, I'm talking of subnational, and the state of Nigeria, that's the federal government, all recurrent expenditure must be funded by revenue, because it's sad to note that previously we have even borrowed to service. We had borrowed for recurrent. It's important that these two are purely funded by revenue generated by the government at the state or at the federal level.
All right, Dr. Olaje, you did mention something there about some of the governors actually inheriting some of this debt. So it almost seems like it's a vicious cycle at this point. One government comes in, one goes out, another comes in, racks up debts for the next one. At this point, should we look at it from should we have some kind of policy that can hedge against, this inheritance, that we've gotten used to when it comes to debt? What can we do? Can we say, you know what, you are not allowed to borrow at this point until we clear up, something? Yes. What can we do?
There must be debt cap. The federal government must take deliberate decision in setting debt cap, and I think that now we are looking at constitutional reviews. It's important to set debt cap. And there are a number of things that can be done. For the performance of the state over the years, what is the maximum limit that a state can collect? I've said that there are other windows, there are other measures with which we can get investment into the state. What we should never talk about is to look for debt to service a current debt or to use debt for recurrent expenditure. That state, a state that cannot use a revenue to finance current debt or use a revenue to finance recurrent expenditure, is largely having significant financial challenge. So, but if it's for capital expenditure, even at that, there must be a cap, such that for such waiver to be given beyond what the National Assembly is doing in auditing, whether it says should get facility or not. But there should be a cap. Because if people from the same political party, people that have political alliance before, they can become biased in giving approvals. But when there is a cap that is strong, and we have allowed experts to help states look at whether they can refinance, or what the impact that will be on their overall fiscal life, then we will start having healthy states. States will start thinking of developing their area of competitive cost advantage over others, instead of everybody wanting to do the same thing.
All right, in your view, do you think Nigerian states are borrowing to invest or just to survive?
I would like you to repeat that question.
Do you think Nigerian states are borrowing to invest or they're just borrowing to survive at this point?
Well, both. And the numbers cannot lie. When states borrow, the essence of borrowing is to invest and ensure that what you are investing on, the returns is enough in the medium and in the long run to pay back the loan. What does that mean? We have states with some areas that are very poor. Allow me to use, for the sake of example, let's say a GRA where the roads are bad. Grade the road, tar the road, make the road habitable. What will affect ground rent of the area? The ground rent goes up. You look at how much you generate in revenue. So, but when you do that, you have borrowed that money and you have invested it in the economy of the state. You have invested it in certain regions. I just use that as example. It's different from borrowing money because we have presented budget and this is what we must borrow. I tell you, I don't want to mention some states that are really culpable because it will look like one is attacking them. But some states, both in the north and south, are really culpable. No, there is no clear demarcation or stating areas where monies, which projects will be financed by borrowing. So if you look at it, for such states, what you do is to calculate their total real capital expenditure. In Nigeria, we have a culture of saying this is recurrent non-debt and recurrent debt or capital. You know, we have a name we give to you. But broadly speaking, your budget is either capital expenditure or recurrent expenditure. But for some states, we have now seen administrative capital. Things that are administration, that are actually recurrent expenditure, but they are extension of capital expenditure. We should look at, if you are borrowing at all, it should be for key capital expenditure. If that happens, then we also measure what is the benefit of this. We are not saying we want to recover it in short term. In some cases, it may not even be medium term. It could be over 10, over 15 years. But the state assembly, the National Assembly should agree that the impact of this borrowing will benefit the people. So, but if you are not doing that, the truth is we are only borrowing for survival.
Right, and looking at the politics of it at this point, when you have the executive and the legislature in good terms, who's going to check who at this point? Because it seems it gets hard for them to check each other.
Well, the check and balance line seems to be fading away, at least for federal, where you would expect the National Assembly to be a bit more thorough in considering the request from the executive for the overall health of our economy and of our nation. And that is a danger of having a very weak opposition among legislature that is not doing due diligence. We are not saying that opposition should serve as a body to disrupt governance or administration in a country or in a state. But we are saying that there must be that voice that must be loud, that must be clear, that must call incumbent to order. We have seen it before in this country without disrupting activity of government, because we don't want our government to be disrupted. But it's important to have opposing views to some things that may eventually, cost us a lot in the medium term or in the long term. So it's important to have those voices. So the National Assembly and state assemblies have a responsibility if truly they want to help the economy to grow further. But we should also know this is my worry. You have seen that fact share to state has sporadically improved. In some cases, 200, 250, and at a few times, nearly 300%. The question is, why are we still worried about borrowing? Why? With the major increments and improvements in what states get. We have seen federal government measure most of the policy we've made. We have pushed them to the subnational in terms of revenue to them. Was that a lie? It's not a lie. It's correct to say that subnational now gets more money. The way federal government gets more money, and more are also going to local government. But what has happened? The way revenue have improved, the way expenditure has even improved at higher rate than the rate of increase of revenue. You want to ask me why? The reason is what led to increase in our revenue. Subsidy removal, number two, which is a key issue we need to look at. The key issue is the valuation of our currency. When you do that, states that receive money also need to spend, especially when you talk of projects. We have seen government legislation regarding minimum wage from 30,000 to 70,000. For those places, you should expect spending to increase as such. But beyond those, when it comes to going to the open market to price, we have seen that states also buy some. There are some states that have light up, state A, state B, state C. Cost of providing such services has also significantly improved. So if you are not careful, we might be having an issue of penny wise, pound foolish. That is why we need to think holistically. Fiscal and monetary cannot exist in isolation. The two must be married in order to give us a quality economy that we want to have.
Right, and I guess maybe another bright spot at this point. We did see the NRS reporting about 28 trillion collected in 2025, and now they have an ambitious target of 40.7 trillion in 2026. Hopefully, that can help to offset some of these this debt servicing and hopefully the principal too. Thank you so much, Mr. Paul Alaja. Always great to have you on the show to help us unpack some of these economic matters. Thank you.
Thank you so much for having me.
All right, to other stories. Now, we see the Nigerian National Petroleum Company says regional cooperation will be key to unlocking Africa's vast gas wealth. Speaking at its National Energy Week in London, NNPCL's Group CEO, Bayo Julari, described the Nigeria-Morocco gas pipeline as a strategic pillar for securing the continent's energy future. He stressed that the shared infrastructure, policy alignment, and faster delivery of flagship projects, expansion of the West African gas pipeline, are critical to boosting cross-border trade and regional integration. The move signals Nigeria's push to position gas as a driver of growth across Africa. This leads us to our next conversation now. Let's see how Nigeria can monetize, its trillions, in gas reserves. Let's discuss this and other matters now, especially the gas master plan. Joining me for this conversation now, we have Dr. Ayodele Oni, is a partner at Bloomfield LP. Great to have you on the show, sir. Good morning.
Thank you very much for having me.
So let's first kick off with the strategic impacts. Now, how significant is the Nigeria-Morocco gas pipeline, for Nigeria's position in the African gas market, and what are the economic benefits, you can expect from cross-border energy trade?
Okay, thank you very much. First, we must realize that Nigeria does hold substantial gas reserves. We're number 9. And we do around 209. We do have around 209 trillion cubic feet of gas, and we have an upside of up to 600 trillion cubic feet. Currently we do about 7.5 billion cubic feet in production, but 60% of that is what is commercially used. 30% is for gas reinjection, and another 10% is flared, right? With programs such as the AKK and international pipelines and the gas flare commercialization program, it suggests that those programs suggest that there are opportunities for us to right some of those wrongs. And when it comes to looking at it internationally, first you need to deal with your local issues. Unintegrated gas pipeline arrangement for the Helps and the Eastern Pipeline. You then want to integrate with OBEN. You've got the OBEN 2 and conversations around the OBEN 3 and integration of all of that. And then you are able to then play a role as a regional hub and to play a role in the global market. And that's when you begin to talk about such pipelines and such as the Morocco pipeline and the arrangement to move gas to North Africa and ultimately to Europe. And it improves our currency position, ensures that we can generate more forex and would have multiplier effect, and we begin to also have industries that are gas based more, doing ammonia, doing urea and everything else where gas is the primary raw material or primary resource. So I think it's good. The gas master plan, unlike what we had before now, this is dedicated per project and it's a document. Of course, the challenge remains around pricing, particularly domestic pricing. We use a reference code system where you have a gas base price, right? That's stratified across industries from power to GBIs, gas-based industries, and exports pay almost double that. So I think that's an area that needs to be looked at again. And the master plan does actually mention that as a problem or as a challenge that needs to be dealt with for us to achieve the goals we want to achieve.
All right, so definitely looking at some of the risks and challenges to this gas pipeline between Nigeria and Morocco. What would you say are the low-hanging fruits we can get to at this point to help us hedge against some of the risks because it's a large-scale regional gas project. What should we do, including regulatory, financing, and some of these infrastructure challenges?
It would be collaborative. We would have transit states. If you have challenges with transit states, then you don't make progress. So regionally, even as a country within Africa, we need to look at our foreign policies and determine how best we can work with countries around us, particularly those countries that be transit states. And it's usually a commercial conversation, right? Such that if everyone finds out that they make money, then they are happy. So we must think about it commercially, beyond what we would have done in the past. I think that's critical, our international policy. And it's good that the president has now appointed ambassadors, who would represent us in those countries. I think our foreign policy is critical. That's one. Commercial arrangement or conversations around how states get their tariffs is critical, and also ensuring that from a financing standpoint, we look at how we can collaborate with international organizations and agencies that can't give concessionary funding. And we'll be looking at collateral funding with those other countries, depending on how commercially viable each country sees such a project.
Let's try and follow the money at this point. And still looking at the gas master plan, for investors, industry players, where are the most bankable opportunities right now, in that gas value chain?
I think it's midstream. There's a lot happening midstream with CNG and LPG. LPG being liquefied petroleum gas for cooking, your propane, your butane. I see a lot of that's low hanging, and the entry barrier isn't nearly as tough as what you have upstream. And with the commercial and executive orders around tax credits for non-associated gas and what we do see as incentives midstream and downstream gas, there are opportunities. And one thing many people fail to realize is, for example, when you bring in gas equipment into the country, there's the opportunity for you to bring that in without paying customs duty. There's that regime in place where you pay only something very minimal. I think about 5% of what you would have paid. So I see a number of CNG projects going on. You see more and more LPG plants. I think those are low-hanging fruits. And you see a number of projects because of our fiscal policies, the HI project, the UBT project, a number of projects, and that have reached FID now, and conversations around FLNG with Chevron and UTM also looking at those. I think that there are opportunities across the value chain once we're able to resolve the problems or the challenges which the Gas Master Plan 2 has highlighted, and these incentives such as VAT exemption on gas equipment, the 35% investment tax allowance for gas utilization, amongst others. Once implementation isn't a problem, you begin to see more and more gas projects. Where we are today is a far cry from where we used to be historically because of the challenges, and because for a long time we had just the Petroleum Act, which wasn't a gas law. It was more a petroleum law or a liquid hydrocarbons law, with only, I think, one or two places where they've mentioned natural gas. Otherwise, it's strictly a law for liquid petroleum. But with the PIA now pretty much settled, and issues such as policies such as the domestic gas delivery obligation, those help move things forward. And you already are seeing projects, even the Lagos Free Trade Zone, the number of projects going on, Lekki Free Zone, the number of projects going on around ensuring that people can move away from liquid fuel and use more gas. So I think that there are opportunities across the value chain, provided that implementation of this document is well done, because that's where we struggle at times. Policy to then practical implementation usually can be a big challenge for us. And ultimately the president wants us to do around 10 billion cubic feet by 2027, and I think 12 billion cubic feet per day by year 2030. So if implementation is done the way it should be done, I think you'd see more projects come on stream.
All right, let's pivot to power supply. At this point, we keep talking about how we want Nigeria to produce more, produce more finished goods, want our manufacturing sector, to get some more action at this point. But without affordable electricity and electricity supply, that's a big bane there. The likes of countries like China, where they say production is cheaper, because electricity is actually cheaper there compared to, Nigeria. So we have that gas to power, initiative there. How viable is it, given the liquidity issues in the electricity market right now?
Yeah, the power sector challenges are historical, and they've remained with us even up to now. Until recently, when NBET issued the bond, I think it's Series 1 of over 500 billion, and I think ultimately it's 4 trillion we're looking at. Gas companies were owed substantially, and other than looking at partial risk guarantee arrangements, gas companies will shut down gas pipelines. So it's been critical because the power sector, two problems: tariffing historically poor, collection being a challenge. So particularly for the grid connected power plants, there are about 26 grid connected power plants. 19 of them are gas fired, right? Thereabout are gas fired. So if they are gas fired, means they will rely on gas. If consumers do not pay, or the tariffs are lower than the cost of production, including gas, or they are historically owed, then we will continue to have this challenge. Now, what a number of people have said is that they are looking at several other captive power plants or off-grid power plants that rely on gas, and in this case they are even able to better afford gas pricing. What we have in the domestic market is dual. We have a dumb gas arrangement where pricing is based on a base price, determined annually by the NMDPRA, I guess working with the upstream commission too. And we have a willing buyer, willing seller. And you'd have pricing from around $2.42 per MMBTU to about $3.16 per MMBTU. And then for export is double, triple that, 6 to 8 or more dollars per MMBTU. That's for LNG, condensates, all of those liquid, natural gas, liquid export projects. So pricing has been a challenge. That commercial arrangement, it seems to be improving gradually, but that's still a challenge. So if the power sector cannot bear, or consumers like you and I either cannot afford or are not paying, or distribution companies cannot collect and then pay everybody else across the value chain, the power sector will continue to suffer. The only could be positive depending on how you look at it. For example, Abia State is gone almost completely off the grid. A number of companies too are going off grid. That could in itself be a positive and a negative, right? You you get off, cannibalize the grid, and you get a lot of people off it. May mean that it's insufficient for the poorest or the least privileged people, but pricing can then be a challenge, because remember, power is on an economics of scale, right? So the power conundrum needs to be resolved one way or the other. With states maybe taking over, you will see some progress, but it may be stratified across the states. So work is being done around infrastructure, metering, and we hope we do see the result. If we see the result and pricing is more reasonable, collection, aggregate technical, commercial, and collection losses reduce, then the power sector is able to better bear gas pricing, then it's even also good for what we want to do under the gas master plan, because the power sector and gas pricing remain a challenge.
All right, Dr. Onuibi, but before I let you go, very quickly now, with all this attention, gas is getting right now and all these ambitious, plans right now with the gas master plan, do you see, if we, do it right, do you see gas overtaking oil in revenue contribution within the next decade?
Yes, I do see that. And you can take a good example from Qatar. Recall Qatar pulled out of Opec once it could run its economy with gas. So, I think the number 3 or 5, and production is around number 6 or 8, between themselves and Saudi Arabia. So they're doing really well. So we could always borrow from elsewhere where they've succeeded. And I think in this case, Qatar is a good example, and even Saudi Arabia. I think that we can have a gas-driven economic growth in the next decade or so, which would not only be also local value addition.
All right, fantastic. Let's see how that plays out. Thank you so much, Dr. Ayodele Oni. He's a partner at Bloomfield Law Practice. Thank you for coming on the show today.
Thank you very much.
I'll take a quick break now. When we come back, we analyze what's playing out in the commodities market. That's in a moment. Just stay with us. For the commodities market update now, let's discuss updates in oil refining and oil production in Nigeria. Joining me for this conversation, we have Halima Dedironche, Senior Associate at Financial Derivatives Company. Great to have you on the show. Good morning.
Thank you for having me, Ladi. Good morning.
Fantastic. Yeah, we have another latest from the Dangote Refinery, reducing ex-depot petrol price by 25 naira to 774 naira per litre and ending its PMS lifting incentive scheme. How might this influence, downstream pricing trends and competition with imported fuel?
Okay, so the Nigerian oil downstream sector is oligopolistic. And what do I mean by that? It entails like a few players: Dangote Refinery, NNPC Limited, and some independent marketers. And so before now, we saw that Dangote dropped the price of PMS per liter by 100 naira in the festive period. It's just like a giveaway or like a festive discount to help in terms of
giveaways,
demand pressure, and to help in terms of managing the lack that we normally have when it comes to oil petroleum in the festive period. Now, coming down to this time, this is more of like a marketing strategy and like a price war in order to capture more market share in the downstream sector by the Dangote Refinery, which is a good one for pricing. It's a good one for inflationary pressure. Before Dangote dropped the price this week, we've seen other players too in the downstream sector doing the same. So this means more consumer surplus for end users, and also it's a good one because it's reflecting that the downstream sector is now deregulated, unlike when we have the price being capped because of the subsidy in the previous event that we normally have. So now it's a good one for Nigeria in terms of companies or households or individuals using PMS. It could help them to at least have a view of how they can invest and how they can do their pricing. But when we look at what is happening in the global oil market, we'll see that there's like a divergence when it comes to the domestic PMS price and the global oil price. And this is because there's always crude oil is always bought forward in the global market because before it is being sold to the end users as a refined product. And so that's why we are seeing that it's not moving in tandem with what is operating currently in the global market, but still it's still a marketing strategy much more than reflecting what we have in the global market. So it's a good one for the economy and inflationary pressure.
All right, talking about giveaways, I guess the average consumer in Nigeria needs as many giveaways at this point. Well, let's look at consumer impact now. To what extent do you expect this price adjustment at the refinery level, to translate into lower pump prices for motorists, across Nigeria?
That's what I just said, that most times when prices are high, we quickly see the effects. Companies quickly shift, prices move faster than even the change. But we've seen that in events of Nigeria specifically, or in a peculiar case, most times when prices of inputs drop, we don't normally see the resultant drop in the prices of transportation, in the prices of goods and services. And this is because it takes longer to translate into that. So we might, if this drop lingers or it extends to a reasonable price, we might see the effect in the price of transportation. We might also see the effect in the price of some goods and services.
Is it until the refinery cuts it to about 500 that we can actually feel it?
Yes, but it's no longer regulated. It is deregulated, as I said earlier. So you might not be able to have that slash, because it will mean a loss for the refinery. So it has to reflect the input cost and the cost of the crude oil in general, and other costs that is associated with the refining of the crude oil.
All right.
So we can't just see a slash.
Okay, let's look at oil production now. Latest data, it's another quarter miss from Nigeria. How are you seeing this play out so far? But it's not just Nigeria. Looking at the data, other producers too didn't really meet their quota.
Yeah, so it's a general thing. So, and I think Nigeria is part of Opec, as we all know, and this body monitors the data as regards what is the production, what is the condition of the country in life. And so we have the primary source, which is also always reported by the Nigerian Authority, and we have the secondary source, which is managed by data analysts and agencies like OPEC. And so for this January, we saw that for the primary data, which was reported by the Nigerian Authority, we saw like a slight increase in Nigeria's oil output. However, in the secondary data, there is a slight decline. So this is like a divergence. And when this happens, it could mean that credibility might be questioned, though both source is showing just like a slight change, which is a good one for Nigeria, showing that investment and also licensing rounds and some efforts to reduce oil theft is gaining ground and yielding some results. But also, because we have that divergence, we might not be able to push for more quota in the OPEC for now, because we are not seeing a direct report when it comes to the primary source and the secondary source. And also it could affect budgeting, forecasting, and even so many other investors that might want to come into the sector to invest.
Right.
So that is it for now.
And I'm sure that would also impact, feedstock for our refineries at this point. Thank you so much, Halima Adediran, Senior Associate, Financial Derivatives Company. Thank you for coming on today.
Thank you for having me, Lad.
All right, let's go global. All right, let's start off with tariffs now. The U.S. House of Representatives voted 219 to 211 to oppose President Donald Trump's tariffs on Canadian imports, marking a rare bipartisan rebuke of his trade policy. 6 House Republicans joined nearly all Democrats in backing the measure, reflecting growing concern that the levies have hurt U.S. consumers and businesses alike. The resolution now moves to the Senate, but is likely to face a presidential veto, making real repeal unlikely without a two-thirds majority. And U.S. President Donald Trump signed an executive order directing the Pentagon to purchase electricity from coal-fired power plants in a bid to support the struggling coal industry and boost domestic energy production. The plan also includes about $175 million in Energy Department funding to upgrade 6 coal plants across Kentucky, North Carolina, Ohio, Virginia, and West Virginia. The move is part of broad efforts by the administration to keep coal plants operating and roll back environmental regulations, even as critics warn it could raise power costs and hinder the transition to cleaner energy. Then the U.S. and Japan are finalizing the first projects under a $550 billion fund to boost energy, semiconductors, and other strategic industries. Officials say initial investments will focus on energy and chips, while details are still being finalized. The initiative aims to strengthen industrial capacity, supply chains, and technological competitiveness for both countries. China, bans below-cost car sales. With China there, banning selling new cars below cost to end a prolonged price war and protect dealers and suppliers. The move targets steeper discounts, especially in the EV market, that have hurt profits and drawn regulatory attention. Officials hope the rules will bring fairer pricing and support long-term growth in the world's largest car market right there. Then EU leaders are set to debate on a controversial Buy European proposal at a summit in Belgium, with some countries backing new rules to favor European companies and others warning it could harm competitiveness. France supports measures to prioritize EU-made goods, while leaders from Sweden and others oppose protectionist steps that might hinder trade and innovation. The discussions reflect broader divisions over how to revive Europe's economy and global competition and geopolitical pressure. Meanwhile, UK Chancellor Rachel Reeves urged the EU not to create new trade barriers, saying open markets benefit both sides. Her warning comes as the EU debates industrial policies that could favor domestic products and affect the UK-EU trade. Reeves stressed that maintaining close economic ties with Europe remains a key UK priority. Also, we see data out today shows the UK economy eked out a 0.1% growth in the fourth quarter of 2025. Now we see German industrial giant Siemens raised its profit outlook after stronger demand for factory automation and electrification products helped offset pressure from foreign exchange headwinds, that's according to the company. The improved outlook reflects resilience in core industrial segments as companies invest in automation and modern infrastructure. Siemens' results signal confidence in ongoing demand for advanced industrial technology, even in a challenging global environment. And Mercedes-Benz says it expects at best, flat profit margins this year as the luxury automaker faces intense competition and tariff pressures in China. That's its biggest market. The guidance reflects ongoing challenges from weaker demand, rising costs, and trade barriers that have weighed on earnings and profitability in the recent quarters. Analysts say the outlook reflects broader challenges for European automakers in tough global markets. Yeah, the local boss right now, that's open, trading about 3 basis points up, 178,000 level, still maintained right there, and most of the stocks there still getting attention. We'll see if we'll get another green close today. More updates on Business Incorporated by 1:30 today on most of the markets that we track. Thank you for watching. I'm Ladi Williams. Bye for now.